Before we talk Stitch Fix, I just want to talk about the market as a whole, guys. If we can bring up the 10-year bond real quick, because Tim, we got to talk about the reaction to this rough ISM lowest since 2009. Now, worth pointing out, that's when the economy was actually starting to pick back up again. But look, this is a bad number. There's no way around it. The 10-year is now running to the upside in a big way, Tim. What's going on down there?
Yeah, absolutely, and I think maybe the notion that the U.S. is almost immune from the global slowdown may be challenged here. And on top of that, kind of obtusely, you had a horrible JGB auction overnight as well, where basically there was a buyer's strike. So be interesting to see what happens here at some point. But I think we're kind of at an inflection point here with the market overall. We haven't been able to break out to the upside at all here. If we fail here after knocking on the door so many times, I think we could see a meaningful pullback. That might not be a bad time to jump into some stocks at that point.
Okay, so now we see the stock market responding to some economic data. But Tim, that being said, it's not even really that deeply negative. You've still got the small caps that are hanging on in the green. What's the concern here? I mean, is now the question whether or not we're going to get dragged into a type of Euro economy slowness, or is there the safety net of cuts still on the way from the Fed that then should put a bottom in? I mean, how are folks sort of thinking about this right now?
And as far as the cuts, I mean, unless we go negative and join the rest of the world in that, which to me is very disconcerting on its own accord. But, I think, we only probably have a couple more rate cuts that would be meaningful at all. Once you get to the low rates, obviously the impact will be less. So I think we're starting to see it in some of these, higher yielding value plays. The Procter & Gamble's of the world's starting to turn over a little bit here. So I think they're kind of signaling that, the rate cut phenomenon to support the market may be lessening each time we do it, and if it does, I think a pullback, although not that 10 to 15% pullback, something more like a 3 to 5%, I think would be healthy for the market.
Yeah. All right, Tim, what are you looking at here this afternoon? I know you had your eyes on Stitch Fix too. It's at the bottom of its range, but as George points out, a mix between real high short interest and then real rough, business model right now as we see the company struggle.
Yeah, absolutely. And barrier to entry on this is almost nil as well. Yeah. Almost anyone who is already doing this can slap up a website with some simple software and do a similar thing here. But we're seeing also implied volatility off the charts here as well. This week's IV over 200. The straddle implying over a 20% move here. So I'm simply taking advantage of that and the fact that this stock has been absolutely hammered, jumping in, getting cautiously bullish, buying next week's 21 calls slightly on the money, selling this week's in the earnings week 21.5 calls, paying only about 30 cents for that, capturing about 70 points of vol edge, buying 130, which is comparatively cheap, believe it or not, because I'm selling a 200 here. And I think that 22 level on the chart where it kind of broke down, rallied back up to and failed, might be the sticking point if we get some decent numbers or even just some okay numbers out of Stitch Fix here. So that's kind of the area I'd like to see it stop at. I'm bullish all the way up. I like that as a call diagonal.
Yeah, all right. Tim, good stuff. Appreciate you jumping on with us, talking about the intraday market here in Stitch Fix too. Looking forward to the earnings. Tim Biggam is lead option strategist at Delta Derivatives.